A major trade dispute is sending some serious shockwaves through a global economy that's already, let's be honest, on high alert. You've got a commodity ban heating up in the east and a government shutdown looming in the west, and right in the middle, you have markets getting squeezed from all sides. So let's unpack how these two massive pressure points are colliding. So, at the heart of all this new anxiety is a really high stakes standoff between two absolute economic giants. And this isn't just some minor squabble, you know? This is a conflict that strikes right at the core of a critical global supply chain. You can feel the tension in this one quote from Australia's Prime Minister. I mean, disappointing is diplomatic language for this is a huge problem. This one sentence was the signal that a simple pricing dispute had just blown up into a serious international issue, putting billions of dollars of trade at risk. So, to really get why this matters so much, we need to look at the relationship between these two countries. Now, what's really fascinating here is the dynamic they've had for decades. It's been pretty simple, really. Think of Australia as the world's quarry and China as the world's factory. Australia digs the raw iron ore out of the ground, and China's massive industrial engine turns it into the steel that builds, well, everything, from skyscrapers to your smartphone. They are deeply codependent, which is exactly why any little disruption here creates such enormous waves. So how did this normally functional, codependent relationship just suddenly catch fire? It all started with negotiations breaking down over just one thing: the price of iron ore. The key player on China's side is this relatively new but incredibly powerful group called the China Mineral Resources Group. Now, Beijing created this state-owned giant for one very strategic reason: to basically centralize all of China's iron ore buying power. So instead of hundreds of individual mills all negotiating for themselves, this one group speaks with one single powerful voice. The goal? To shift China from a price taker to a price setter. And this timeline shows exactly how they decided to use that power. The price talks with the Australian mining giant BHP, they just hit a wall. When they couldn't agree on a price, China pulled out its trump card: a ban on all new shipments that were priced in US dollars, which, is the global standard. What you have to understand is that this wasn't just some negotiation tactic. It was a hard stop. As you'd probably guess, a move this drastic doesn't happen in a vacuum. The financial markets reacted almost instantly, and those ripple effects started spreading really fast through the global system. So the most immediate hit, of course, was on BHP itself. The company's stock dropped 1.5% pretty much the second the news broke. Investors saw the risk right away. I mean, China is their biggest customer. Getting cut off, even for a little while, hits the bottom line hard. But the impact went way beyond just one company. The dry bulk shipping index, which is a key indicator that basically measures the cost of shipping raw materials around the world, it collapsed by over 5%. Now, to put that in perspective for you, iron ore makes up about a third of all dry bulk shipping. So when that volume just freezes, the entire global logistics network feels the chill. And this brings us to the bigger picture here. This whole dispute isn't happening in a time of global calm and stability. Nope. It's hitting a market that is already incredibly nervous and on edge. Which kind of begs the question, right? Why is one commodity dispute, even a pretty big one, causing such widespread jitters? Well, it's because it's not the only fire that's burning right now. Just as markets were trying to digest the news from China, another crisis was brewing across the Pacific. Washington was getting closer and closer to a full-blown government shutdown, adding this massive dose of political and economic uncertainty into the mix. Now look, government shutdowns aren't exactly new, but the memory of that last major one back in 2018 and 2019, that's what has markets so worried. At 35 days, it was the longest in US history, and it really showed just how disruptive a long political stalemate can be. So what does a shutdown actually do to the economy? Well, it creates this perfect storm of uncertainty. First off, the data just goes dark. All those key reports on jobs and inflation, they get delayed, leaving everybody flying blind. This puts the Federal Reserve in an absolutely impossible position. How can you make decisions on interest rates without any reliable data? And for investors in a market that's already at peak valuations, a shutdown is the perfect excuse to just sell first and ask questions later. So with a trade war brewing in Asia and political gridlock basically paralyzing Washington, it's really no surprise that investors started this frantic search for safety. I mean, when risk is popping up everywhere, where do you put your money? The answer, as it so often is in times of crisis, was gold.
The classic safe haven asset just surged, hitting new record highs as investors fled from stocks and other risky assets. They were looking for something tangible, something real to hold on to.
And we're not talking about a small move here. The price of gold rocketed up to $3,890 an ounce, getting really close to that major psychological milestone of 3,900. That kind of powerful momentum, well, it just shows you how deep the anxiety in the market really is right now.
This slide here really just ties it all together, doesn't it? You have the commodity disruption from the China-Australia ban, which causes mining and shipping stocks to fall. Then you've got the political gridlock from a U.S. shutdown putting pressure on U.S. futures, which are basically bets on where the stock market is headed. Both of these things create massive economic uncertainty, which clouds the Fed's path and triggers that classic flight to safety we just talked about.
And all of this leaves us with one final critical question. When the world's factory and the world's largest economy are both sources of instability, the old rules of investing just don't seem to apply. Gold might be the obvious answer today, but in a world with this much friction, well, the search for a true safe haven is really only just beginning.